Here are the best crypto trading strategies we can carry out on Bybit. Number one is just buying Bitcoin every single week forever. We become long-term investors and we become the moving average of the price. That's good because the current run rate for Bitcoin annually is 50% a year. So you have to be a long-term investor, buy highs, buy lows. We're going to do that. We're going to go to the spot market here, and I've got some USDT and I'm going to put in a limit order. Let's buy an amount of Bitcoin, put our limit order in, buy BTC. Like this, our limit order is in a little bit below the price. That's fine for me. The price bounces around, so we'll probably get that done. Why should you buy Bitcoin every single week? Look at this. This white line here is the moving average. We want to become that, and so we buy every single week and we become the moving average. For a normal rate of return for BTC, 40% going down to 30, going down to 25% yearly returns. We're looking at around 400 to 500K BTC in a decade. If we look at the rate of return currently for Bitcoin, you can see this is 50% annualized. So invest through the volatility and let the outperformance play out over the long term. 50% a year returns. That beats every other type of large-scale investment. We can also use trading bots on Bybit to take the emotion out of our trading and automate our buys. So go to Tools and then Trading Bot and DCA, press Create Now. I'm going to dollar cost average BTC each and every week like this. And you can add other cryptos in here if you want. So if you want other cryptos, you can just add them in, add the amount that you want to actually buy every single week or every single month. It's up to you. And then the total amount of the investment. That's optional, but you can put that in, press create now. That's going to buy automatically at the investment frequency that you set out. I would recommend just trading in the spot market each week. You probably get lower trading fees here because this is just going to buy at market. I'd recommend putting in limit orders a little bit below the price. It's just what I'm used to, but it's up to you whether you want to do it manually or you want to automate it through the trading bot. If you are new to Bybit, they do give deposit bonuses when you sign up. So check the link below. You can get up to $30,000 as a deposit bonus. Now, depending on how much you deposit, you can get up to 30K, but you can also get less than that if you deposit less as well. So whatever you deposit, you should be able to get a bonus there. So you can check the details via the link below if you are new. But the next strategy is, of course, taking long positions in bull markets. That's what everyone wants to do. A lot of people trade on Bybit futures and take leverage on their positions, and they can do that if they're a little bit more advanced. Or you can just use this to buy Bitcoin in the spot market, buy it and hold it. Don't take any leverage, don't take any extra risk during bull markets as well. So what I've done here is on TradingView, this is my long-term analysis of the Bitcoin price. Now I give this to course members as well, but you can do this yourself. So Bitcoin, any of the Bitcoin charts on TradingView, the blue lines are halvings right here. We can very clearly see that after each halving, there is a bull market. And so we can trade that. You can put this on yourself. You can go to the price ranges here, put these price ranges on, color them. You can very clearly see the bull markets and then the bear markets. So what do we want to do? We want to trade in a bull market and we want to trade drawdowns. This is also free. This is Glassnode. Again, I'll link it below. These are drawdowns in bull markets. Bull markets are uptrends. Very clearly, Bitcoin has these bull markets around halvings and after halvings, and also coincides with the macro cycle, but that's too much for this video. We can see that in bull markets, Bitcoin will draw down 30% regularly, and it may go down to 30, 40, 45% drawdowns if they're pretty harsh. So we can play the odds, and if we do get a 30% drawdown, 20 to 30%, we can actually try to take long positions, knowing, and this is short-term trading by the way, so if we know that drawdowns occur in bull markets around 30%, we can take positions around that. And we can also have a stop loss level because we're trading short term, taking a little bit more risk here. We can have a stop loss level around the 40+% drawdown area. And playing the odds, we will probably be quite successful doing this in bull markets. So we take positions when the price draws down around 30%, maybe have a stop loss around 40% level, take a bit more risk, and we hope we're in a bull market and that price will recover again and we can make some profits. How do we actually go ahead and trade that on Bybit? Well, if you're trading in the spot market, you just want to buy and hold BTC, then accumulate some here, right? Get a decent price for your trades during a bull market with these drawdowns. A lot of people will trade more actively and trade in the derivatives market. So we're going to be trading futures right here. And what we're going to do is take some leverage. So 2x leverage. That means that if we put $1,000 down into the trade, we can trade with a size of $2,000. That's a little bit more risky. Of course, losses can come around a bit quicker. We can make gains a bit quicker as well. I don't recommend leverage to beginners for sure, but let's put $1,000 into our trade. You can see here the cost of our order is only 500 because we're using 2x leverage. So we put 500 down and our trade size is 1,000. And if we're getting in at these levels, maybe we get some decent prices. We can see a bounce and we can either take our profits early or run them through the rest of the bull market. Now, leverage. What does this mean? We're putting 500 down and we have a position size of 1,000. So essentially, if the price draws down 50% from our entry, so let's say we're in at 55,000 because we drew, one of these two, right? So around 55K. If the price draws down 50% from our entry, we get wiped out. We've got $500 in the position. The actual position is worth $1,000. If we lose 50%, we lose $500, we lose all our money. So you can see that the percentage moves have actually been doubled in terms of the amount of money that we've put in. So a 50% drawdown actually equals a 100% drawdown for the money that we've put in. But we have to put less down into the trade. We have to put less on the platform. We can use our money or assets in other ways to earn some yield as well. So we don't have to put all of our money into the trade. But if you're getting at 55 and you're saying, well, that's a 30% drawdown more or less from the range high, are we going to get in here and see another 50% drawdown? Probably not. And so, my stop loss would be somewhere around here. And that's fine for me using 2x leverage because my position would actually get stopped out, far below that, right? So somewhere around here. So I'm stopping myself out before my position would get liquidated. So we go in here with 55,000. We're going to put 500 into the trade, which is $1,000 actual position size. And we're going to put a stop loss in right around this level here, which is around 45K. So we'll put a stop loss trigger, 45,000. We sell out at a loss if the price gets down there, and that's fine. That's day trading. We take positions with a little bit of risk, but 30% drawdown to 40% drawdown, it's quite normal. And we're not taking any leverage that's actually going to stop us out before our own trade idea. So 30% drawdowns are tradable, I think, in bull markets, expecting it can go down 40% or so. And so you want to give your trade a little bit of room. You don't want to use too much leverage. But as you can see, that is a way to actually trade the market using the odds of drawdowns and hopefully having a decent hit rate. If you've done that this bull market, you can see you've pretty much traded every single one of the best trading opportunities. And you can actually add to this as well. So go in small to begin with. As the price draws down, maybe enter another. As the price draws down, enter another. That's a bull market. That's trading drawdowns within a bull market, trying to take a little bit more risk and trying to take advantage of positive price action over 12 to 18 months of a bull market. We don't always have to take extra risk with our portfolio. We can also actually reduce the amount of risk by using futures and options as well. So another strategy is to use the yield that you get in certain crypto assets to your advantage and without taking any risk. So what we're going to do is we're going to buy staked ETH. That gives us a yield. And we're going to buy that staked ETH. And obviously, if you do that, you take a long position in ETH, right? So you're taking a long position in ETH. And because it's staked, you're earning around 2.82%. You can go ahead and do this on Bybit. So staked ETH is the largest version of staked ETH. This is from Lido. You can go and stake now. You can do it with Mantle ETH as well, which is Bybit's version of it. But staked ETH is kind of the big one. So 2.82% is the APR we get from buying ETH and staking it on the platform. You can buy that and press stake now. It's actually free on Bybit. I've got a tutorial on that. I'll link it down in the description. So 2.82%, and we have a long position in ETH. But what if we don't actually want to take a long position? What if we don't want price exposure to ETH? We can actually create a synthetic neutral position whilst gaining this yield. 3% doesn't sound a lot, but in the futures market, you probably will get paid extra as well if you take a short position. This is the Ethereum chart in Bybit futures. And what we can do using futures is take a short position on the price of the asset. So we're going to go ahead and buy some staked ETH, and we have an asset value there, call it $1,000. We're going to actually transfer that staked ETH into our unified trading account. I've got that in my funding account right now. You can see staked ETH. We're going to transfer, then we're going to go from our funding account, and we're going to put that into our trading account, press confirm. That switches it over to our unified trading account. Back in the unified trading account now, what we can do is take a short position on the price of ETH using ETH as collateral, right? So let's say we had 1 ETH there. We're going to open a short position with 2x leverage, and we are going to take a synthetic position of 1 ETH or call it, $2,500, whatever it is, right? So you have to work out what is the amount of ETH that you have in your unified trading account right now, right? So if you've got $1,000 worth of ETH or you've got 1 ETH, work out how much that is worth. Then you take a synthetic short position in the futures market. So we're going to open an order here. We're going to open an order for the exact amount. So I'm actually going to switch this to order by quantity because that's easier. I'm going to do 1 ETH short position. I'm going to use 2x leverage. That's fine. So what that means is that I can actually open a larger position size on the short side than I've got. And that's fine because if you think about it, I've got ETH here in my unified trading account as collateral. As the price moves up, my ETH gains value, my short position loses. They cancel each other out. It's a delta neutral position. You have long and short the exact same amount. So they move around, one cancels out the other. If the price moves down, my ETH loses value, but the short position is gaining equity in the account. So the point of this is that you are trading essentially a delta neutral position, one long, one short. Neither of them is going to make any money. Why do we do this? Because now we have very small market risk, but we are earning 3% on the amount that we put in. We also, most of the time, earn positive funding as well in the futures market. You can see that right here. Usually the funding is positive, and you can see that it's 0.01% right now. I think this is exchanged every 8 hours. I think it comes out around about 3% or so that you're getting from the funding rate. So if you're taking a short position, you're actually benefiting from the funding rate on this occasion. And so 3 and another 3, you're talking about a 6% yield, essentially on a delta neutral position. Now, this isn't taking extra risk. In a bull market, you don't really want to do this. You just kind of want to be long the asset because you can maybe make 50, 100% in a year with ETH, right? If the growth rate is pretty good. So this is actually reducing risk and just using the market to take some sort of yield out of going long staked ETH, getting that staking yield, and then going short in the futures market. You get this funding rate, and then you're actually taking a delta neutral position. It's actually less risk, less yield, but it's something that you may want to do to actually take advantage of the yield in the market. Some of the risks here is that you're using a centralized platform. Your position may have some issue with it if it's not perfectly delta neutral. Also, the funding rate can actually go negative sometimes. So if you're taking a short position in the futures market, you actually will have to pay this out, and so that reduces your yield over time. Most of the time, though, it is positive. In bull markets, this can get pretty high, like 10, 15, 20% yield on an annual basis, and then plus the staking rewards. So if you want to take less risk and not just take positions on the price moving up or down, this is one way to do that with crypto. Another way to use assets that we have to trade with and try and trade around our portfolio rather than just dollar cost averaging. I think that's number one, right? Dollar cost average BTC making 40 to 50% a year. But after that, you want to trade, maybe you want to express a view for 10% of your portfolio. Maybe you think the bear market is just so obvious that it's coming that, this is something that I can do. Remember, in a bear market, you're going to be losing value, right? And so how do you trade around that to actually lose less value over time or take advantage of falling prices? Well, what we can do is pairs trade. So let's take Bitcoin again. We have a Bitcoin stash. How do we actually trade that versus other coins to try and essentially get some money back in a bear market? Because we don't just want to sell. You don't just want to sell BTC. That's your asset, right? So yeah, you can sell it and you can maybe try and buy it back later. That's one way to do things. But a more professional way is, just to keep your assets and then use them to actually trade with. These are very typical phases. Again, Bitcoin has very typical bull and bear markets, and then Bitcoin versus altcoins, you can also see these phases play out as well. So this is from Pantera Capital. You can see that this is the altcoin market share, and during the peak of bull markets, you can see altcoins get a lot of attention and they get bid up, and their valuations in relation to Bitcoin rise. That's kind of the end of a bull market. Now, that's where a lot of people make a lot of money on their altcoins, and you can do that. But after phase 2, which is typically the end of a bull market, so what you usually get is Bitcoin just going through higher highs and higher lows and uptrending. And you can see that's a bull market. When Bitcoin eventually kind of starts to peter out with its gains and starts to actually price in maybe the next slowdown and bear market, altcoins tend to do really well during the end. And then from there, you get the next bear market. So rather than just trying to time that and sell our BTC, what we can do is trade the delta between altcoin valuations, which are typically very high right now at the peak of a bull market versus Bitcoin. And as they fall off, that delta is going to change and altcoins will lose more value than Bitcoin. And you can actually trade that here. In this bear market it happened, you can see they got very high and they fell off, and then they got higher and then they fell off here, right? So we can actually trade that and try and use our Bitcoin without selling it to try and take positions versus some other altcoins. This is an example of one asset. So we'll look at Solana here, outperforming Bitcoin this cycle. It's outperforming the bull market. Altcoins like this tend to underperform in the bear market as well. So rather than just selling our BTC, what I've done here is I've transferred some of my BTC. So you can press transfer again from funding account into unified trading. You can actually switch your Bitcoin into here, and then you're using that as collateral to take a short position in Solana versus Bitcoin. So you've got BTC, that's your collateral, and that may be going down in value during a bear market. But if the other coin goes down in value faster, you're making money on that trade, making a little bit back. So what you would do is actually use the Bitcoin collateral here, but we're in the derivatives and we're trading Sol USDT. That's fine. We're using Bitcoin as collateral. So this is essentially a pairs trade. We're going to go short. We're not going to use too much leverage here because that would be crazy. So confirm, and we're going to take a short position, on whatever it is, take a short, sell short. We're using Bitcoin as collateral. So as long as the altcoin that you're shorting here is going down at a little bit of a faster rate than your collateral, in this case BTC, then you'd be making money in that trade. So it's a way to try and play the different cycles. Again, this is a little bit risky, so I wouldn't use whole portfolio here. Again, 10%, trade around the edges. If you think this is going to play out, could be Sol, could be anything. There's actually, a lot of meme coins here as well, which are going to do obviously terribly in a bear market, going to way underperform BTC. So maybe one of the silly meme coins, you can just take a short position using your BTC. Now, again, can be risky, right? Because those things are very, very volatile. And so it can actually wipe you out of your Bitcoin. But that is something to try and play if you are looking to trade more actively, rather than just long and short these coins with USDT. We can also use options to trade around our portfolio, try and earn some extra yield out of the market, and actually without taking much more risk compared to what we want to do anyway. So I'll explain dual asset here. This is in the finance section. I think it's structured products and dual asset. So I'm going to go through this simple version here. If you want to learn about options, I've got some other very, very in-depth videos on that. I'll link them down in the description. It's way too much for this video. They are very complex once you get into them, calls and puts and either buying or selling those. So we'll keep it more simple for this video. This is still advanced though in terms of most retail traders. So what is an option? An option is a contract between you and someone else to do something in the future. So you can either buy an option, and that means that you pay a premium. So if you have the option to trade in the future, you have to pay someone for that option. Think of insurance. If you get insurance on your house, you have the option to claim something in the future if something happens. You don't have to claim, but you may want to. So when you buy an option, you pay money. It's called a premium. You pay money to someone else to give you the option to do something. You can pay money to be able to buy something in the future. You can also pay money to be able to sell something in the future. So if you want to go ahead and buy options, you can do that. You can spend some money and you get the option to buy or sell at a specific price in the future. Now we can use those to speculate, right? So for example, I can buy a call option. That means that I am paying someone for the right to buy their Bitcoin in the future at a certain price. And if the price goes up a lot higher than that, then that's great. I'm going to earn a load of money. Essentially what I'm doing is betting, because you pay the premium, and if it doesn't go up, you lose all your premium. But if you win, you obviously win big, because you're essentially taking leverage here, because the premium is usually quite cheap in comparison to what you may buy in the future. In any case, that's speculating when you buy options. When you sell options, what you're actually getting is the premium that other people pay. So if you have assets, you can trade options around them, and you can earn the premiums that other people pay you. Now, that seems great. And of course, you can earn those premiums, which is something that can augment the returns of your portfolio. This is something professionals and hedge funds do all the time, is selling options around the portfolio to earn yield around different types of assets. The downside of options is when you actually have to go ahead and carry out the option. So let's go through that. This is called buy low. And what this actually is selling a put option. So we are taking the premium, taking money from someone else, and we are saying to them, I will buy your Bitcoin at a certain price in the future, but you have to give me that money now for the option. Now, what we're doing here, so I'm going to subscribe, let's say 1,000 USDT here, and the target price. I think the current price is 63,800, as you can see. So I actually bought those 888, spot 88 a little bit higher. I could have got them even cheaper, right? So target price. We're going to say that the target price for us is, let's say, 63,000. So what are we saying? We are saying that in one day, I am willing to buy your Bitcoin at 63,000. Now, the other guy, why would he pay us for that option? Well, because he wants insurance. He's got Bitcoin and he can sell it now at 63,779. But what if he waits and tomorrow the price is 62,000, right? So if it's 62,000, then he has to sell at 62,000, which is lower than now. Maybe he wants to do that. We could do it days out. You know, these are 1 day settlements, but you have 2, 3, 4, 5 day settlements, as you can see here. Just keep it simple for this. So 63,000, he's going to pay us a premium. He's going to pay us this premium for this insurance that if tomorrow the price crashes to 22, he can sell it to us at 63. So the downside for us is that we may have to buy at 63 if tomorrow the price is at 62. We'd have to buy at 63. So as long as you're kind of okay buying Bitcoin around this price anyway, right, then you can try and earn some yield off your USDT. So we can see here that if the settlement price, that is the price when this contract expires tomorrow, is under 63K, this guy's going to exercise because he's going to sell us at 63 and he's going to go and buy back in the market at 62 and he pockets a difference and makes his money. If the price is above 63, you can see that we actually receive Bitcoin in that case because we're saying, I'll buy your Bitcoin at 63 tomorrow. If the settlement price is above 63K, then he is not going to exercise our option because he can go to the market and buy at 64. We just keep his premium. So we put 1,000 in, we get 1,004 out. Now, that's not a lot, right? But if you annualize that, it looks like a high APR, but it's not APR. We're actually just getting premiums. So that is how selling puts works. And so we do take a little bit of risk because if the price comes down, we actually have to buy Bitcoin at a higher price. But we buy Bitcoin at that 63,000 and we also keep their premium as well. So this is something that you can do, you know, if you think that the price isn't going to go down too much, right? And you don't really want to buy Bitcoin, then you can earn those premiums and earn that yield from what you're doing. Or if you think, you know what, I'm happy buying at 63K, I'm happy doing that. If it gets down to 62,800 or whatever, that's fine. Like you can buy some here, you can buy some there. That doesn't really matter. You can do that. You can actually start buying Bitcoin, but also you are getting premiums as well. And so if you're going to be buying anyway, right, why not actually just sell some puts and you might get some premium here. So it's just trying to get better prices for trades and trying to, you know, augment your actual buying of the BTC, right? So trying to get a little bit more out of the market by trading options instead of just going ahead and smash buying. The flip side of this is if you want to sell calls. So that's what the other side, sell high, is. Sell high is if you have Bitcoin. And what are we doing here? We're giving people the option to buy our Bitcoin at a higher price. Why would they want to do that? Well, they're taking leverage, right? So what they're doing is they're paying us a very small amount for the right to buy Bitcoin at a higher price. Now, if the price gets there, they can make a lot of money because they pay us a small amount for the right to buy a certain amount of BTC. So they put a very small amount down into the trade. And if they're right, then they buy from us at 67K, but let's say the price is 68. They can make a big percentage profit on the amount of assets that they put down. So that's their thing. They're thinking the price is going to be very bullish, so they're going to buy calls from us. We have the Bitcoin, and we're selling them the calls and getting their premium. So again, if the target price is 67 and it expires tomorrow, if the settlement price is under 67,000, they would not exercise the option because they have to buy from us at 67. So they're not going to exercise if the price is at 66. So what do we receive in that case? We receive our Bitcoin back plus the premium that they paid. And so that is how you augment your portfolio, right? So if you think the price isn't going to be too bullish, right, and you just want to sell calls out the money, right? So the current price is, let's say, 63. You're selling calls at 67, probably not going to get there, right? Like it's not going to move that much in a day, probably. So you've got the Bitcoin, but you want to augment things. You want to actually make some APR on the Bitcoin that you have. You're selling these calls out. They're not being exercised. You're getting the premiums in and you're making some yield on your BTC by selling these calls. The downside is if the price goes up to 70K in one candle, you would have made a lot of money on your Bitcoin. You have to sell it at 67,000. And so they're going to exercise. They're going to buy it off you at 67,000. You're going to get dollars. So you've sold, you've capped your upside to 67K. If the price is 70, we only get 67K for our Bitcoin. We get these dollars and they obviously go out and buy ours and then sell it in the market immediately. They make a big profit. So there are upsides and downsides to both of these. But you can see that you can use options to augment your portfolio. You have assets, you keep them there, you dollar cost average over the long term. You made that 40 to 50% yearly in right now in Bitcoin. That's going to come down over time, but you can augment things and actually make extra out of your portfolio around the edges. And this is something that a lot of people want to do, right? Just use your assets to your advantage. And if you sell and buy at different prices, you can actually make these premiums as well. But of course, the downside here, whenever you trade, whenever you take a position, is that you might get caught out on the wrong side. But at least with options, you're not going to be too far out, right? So if you average cost of Bitcoin is 20K, 30K, and you're selling at 67 instead of 70, it doesn't matter too much, but you're trying to get those premiums out. So that's one way that professionals will try to actually earn extra on the assets that they already have. If you're new to Bybit, they do give a deposit bonus, so check the link below for that, and some other helpful videos will be listed down there as well. I'm James, it's Money DG. Cheers for watching, and I'll see you in the next one.